Good afternoon, ladies and gentlemen. Thank you very much for joining our webinar for today on IFRS and IAS Marathon. I just wanted to share a few things with you, and that's why starting the webinar from this. First of all, thank you very much for all the feedback that all of you have been sending us. This is very, very encouraging and really, really encouraged and motivated to run more sessions like these for you. I think it goes without saying that feedback that you people have been sharing with us, it definitely is a source of encouragement, motivation for all of us, not just for ACCA, but for our the members also. Mr. Abubakar, he's been, we are regularly conveying your feedback to him, and therefore it's a motivation for all of us. I just wanted to make a few announcements. A lot of you are sending us emails asking about your certificates, asking about your the handouts or the recordings. Let me very clearly explain everything to you. Number one, certificates for all previous sessions have now been issued. They were sent out yesterday to all the members, all the people who had participated live. Please remember, only those individuals who are attending these sessions live are being sent their certificates. Those who watch the recordings, they don't receive the certificates. However, they can claim non-verifiable units for having attended or having watched the recording. Right now, we are using our GoToWebinar channel, which you can access directly by going to www.gotostage.com. It's GOTOSTAGE, gotostage.com. And if you search ACCA or if you search IFRS trainings in there, it'll list all the videos that are available there. However, after every session or while sending out certificates to all of you, we do mention the links where the recordings have been placed, number one, and number two, the shared directories, the online directories where we are putting up all the handouts. So people who are watching the recording, and if they want to access the handouts, they can download it from that particular link. It's on Google Docs, so you can download it from there without having to go through the hassle of contacting someone at ACCA and then us having to email those documents to all of you individually, which becomes quite a bit of hassle. So they've all been uploaded on Google Docs, and the link is being shared with all of you. When we send out the emails with the certificates, it contains the links, so you can access it from there. We did receive some emails that you were unable to open up the recording. The response to that is that the recordings are very much there, they're accessible. However, your browser settings could be such that they may not be allowing that content to be played. So if you could look at your browser settings or try to open up these video recordings in another browser where the settings are different, I mean, that would probably solve the issue. So there are certain browser restrictions which sort of stop your browser to open up a document from Google Docs, for example. So if you can change that, fair enough. If not, use another browser and try to access the same resources. So thank you very much once again. I think I cannot reiterate the fact that your feedback, I cannot reiterate the fact enough that the feedback that you provide us is very, very valuable to us and is regularly conveyed back to the trainer. So for example, an ACCA member suggested to us that we should spend more time on disclosures, and that was immediately discussed with Abubakar Sahib, and he had already sort of received this feedback, and he has now incorporated more disclosure related information in the webinars. So thank you all very much. I'm sure we are continuing to add value to your professional development, to your ACCA membership. So continue to watch us on this channel. Thank you very much. I'm now handing over to our trainer, Mr. Muhammad Abubakar.
Thank you very much, Mr. Harun. Assalamu alaikum. Good evening, respected members. Uh, I would like to thank you at the start of this session for your valuable feedback. And today our topic is IFRS 15. Can you people hear us? Please share your feedback. If you can hear me, please say yes. Okay. People are saying they can hear us. Okay. See, IFRS 15 is a complex standard introducing far more prescriptive requirements than were previously included in the IFRS that it replaces, like International Accounting Standard 18 revenue, International Accounting Standard 11 construction contracts, and a number of interpretation related to those standards. And therefore, it may result in substantial changes to revenue recognition policies for some entities, and it requires the application of significant judgment in some areas. But in other areas, it is relatively prescriptive, allowing little room for judgment. The main specific topics on which more prescriptive requirements have been introduced include the identification of a contract with customer, number one. Number two, the identification of distinct performance obligations and the allocation of the transaction price between those obligations. Then accounting for variable consideration and significant financing component. Recognition of revenue arising from licenses, and presentation and disclosure of revenue from contracts with customer and other balances related to revenue. Other changes include the scope of IFRS 15 has been expanded to cover costs relating to contracts. The recognition of interest revenue and dividend revenue are not within the scope of IFRS 15. These matters are now dealt with under IFRS 9 financial instruments, or for entities that have not yet adopted IFRS 9 IAS 39 financial instruments recognition and measurement. And specifically excluded from the scope of IFRS 15 are the non-monetary exchanges between entities in the same line of business to facilitate sales to customer or potential customers. This scope exclusion is different from the related guidance under ISA 18, which refers to exchange transactions that are not regarded as transactions that generate revenue. These are transactions in which goods or services are exchanged or swapped for goods or services which are of a similar nature and value. So this was a summary of some major changes in the standard. Okay, let's start with the standard. And in today's session, I will try to discuss the transition provision at length. Because this standard is applicable from 1st January 2018, so you need to apply those transition provision, because as compared to our last session on this same standard, standard setters has given some relaxation so far as the application of this standard is concerned. They have given some other approaches as well so far as the retrospective application is concerned. So we shall be discussing in a practical way how can you apply this standard, what are the options available if you feel that retrospective application is difficult or complex, or you cannot apply for those, especially those contracts which are running from last couple of years, or maybe more than like 10 years or something like this, or any contract which started and ended mean somewhere in an year, which is appearing in the comparative information. So that's why how can you apply, what are the options available, what are the possible types of contracts which may need to be taken care of, we shall be discussing towards the end of this session. International Financial Reporting Standard. International Financial Reporting Standard replaces the following standards and interpretation. As I said earlier, International Accounting Standard 11, construction contracts, International Accounting Standard 18, revenue, interpretation 13, customer loyalty programs. Now, this loyalty programs will be dealt under this new standard. Interpretation 15, agreements for the construction of real estate. Interpretation 18, transfer of assets from customers. And SAC 31, revenue barter transaction involving advertising services. And likewise, IFRS 15 applies to all transactions with customers except leases within the scope of now IFRS 16, insurance contract within the scope of IFRS 4, in fact, financial instrument and other contractual rights, and obligations within the scope of all these standards, like IFRS 9, IFRS 10, IFRS 11, IAS 27, or IAS 28, non-monetary exchanges between entities in the same line of business. See, there are many aspects of these standards, like licenses, royalty programs, and each warranties, each of that requires a lengthy discussion, a detailed discussion before reaching to any conclusion. But what I did for this 3-hour session, I selected most of them, and I will try to cover them practically, so that this session should become a useful session for you people. Whatever we discuss, that should be, I will try to make it as clear as possible with the help of different examples taken from the standards, taken from the other sources, taken from my own firm sources, or from our own practical experiences. So I will try to make them as clear as possible. So I would request that your questions should be specific to the concept which is being discussed, because within this 3-hour session we cannot cover this standard 100%. So again, excuse me for not including the disclosures of this standard, because this standard has got extensive disclosure requirements. So if we include that, we cannot discuss. We will have to forego a number of important areas in this standard. So again, another thing is this will be applicable from this date. Early application is permitted. Okay. Again, I would request members and other professionals who are sitting in group, please be quiet during the session, and they should not start commenting or discussion while session continues. And similarly, please have a notebook and pen ready in case you want to note something, or we may need to make small calculations. Then that notebook and pen will be helpful. And similarly, though it is a small session, I don't see that I don't expect that you will feel I mean, you will become bored. But anyway, in order to avoid laziness or to make sure you remain attentive during the session, so it is better have some toffees or chocolates, of course, of your own, not of your neighbor. Okay. The core principle here is, this is the core principle, in fact. The entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring promised goods or services to customer at an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. The core principle is, in fact, the satisfaction of the performance obligation and the recognition of that amount which is expected to be received, in fact. These two things are important. So because this is the key principle within the standard, so this will keep coming back within the standard. Fundamentally, you should forget about the old requirements like matching revenue to cost, and potentially forget about strike lining as a default recognition method for some services. Because in ISA 18 provided recognition guideline for the recognition of services separately and guideline for the recognition of goods separately. But here in this new standard, same guideline will apply to the goods and the services. So there is no separate guideline. Similarly, as I mentioned earlier, a lot of interpretations are now superseded, and I mean, all their requirements are being covered by this new standard. Okay, in fact, this is termed as, in fact, 5-step model for the recognition of revenue. Standard has given 5 steps. Like if all steps are, you will be applying all these 5 steps before the recognition of revenue. Step 1, step 2, step 3, step 4, step 5. Step 1 will teach us, is there a contract? If we conclude after applying step number 1, there is no contract, so this means you need not to think about the rest of the steps. You cannot recognize revenue. If step number 1 holds, contract is there, then you will go for the step number 2. Then you will identify within that contract, is there a single performance obligation or multiple performance obligation? If there is a single performance obligation, fine. Step 2 provides us guideline about how can we identify whether the goods or services being supplied under that contract are distinct or not. Then step number 3, determination of the transaction price. If in step number 2 you concluded there is only one performance obligation, so mean step number 3 will become simple. Step number 3 will become simple. All the price will go to that single performance obligation. But if in step number 2 you determine that there are more than one performance obligation, then step number 3 is a little complex. Then you will have to segregate. Then you will have to allocate that transaction price to each of the performance obligations. Then step number 4, I explained step number 3 and 4 at the same time. In fact, I explained step number 3 and 4 at the same time. Step number 3 is simple. I mentioned step number 3, but in fact, I was explaining step number 4. Step number 3 is simple. what is the transaction price, that is normally straightforward. Step number 4 is basically the allocation or the division of the total transaction price among the performance obligation which we have identified in step number 2. Then step number 5. Now, once we calculated the amount of transaction price to be allocated to each performance obligation, step number 5 will teach us like should we recognize that amount over the time or at a point in time. So these are the 5 steps which we will work through in turn. And we will cover additional areas as well. I will try to be as practical as possible. I have a couple of questions as well from some of respected members. So I will try to cover those questions during this session as well. But in case these are not covered, so they can ask those questions. But I have I'm going to open those questions in front of me, so that while discussing or discussing all these steps and the requirements of this new standard, I will try to cover those questions as well. So this is good. This practice is good. I appreciate, like Naeem Qureshi, this helps me in planning my discussion. So something which is like creating problem in your mind. So it is better if you could send it before the start of the session. So this helped me in planning my session. Okay. Now let's move to step number 1. Step number 1 is basically you need to identify, is there a contract with the customer? So this is the first step. So what is the contract? So for contract, the parties to the contract must have approved the contract in writing, orally, or employed by customary business practices and are committed to perform their respective obligations. So the entity can identify each party rights regarding the goods or services to be transferred. Meaning within that particular contract, these elements should be there. Number 1, that contract is approved by the party. Number 1. Number 2, the entity can identify the respective each party's rights regarding the goods or services to be transferred. The third one is the entity can identify the payment terms for goods or services to be transferred. Fourth one is the contract has commercial substance, that is the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. And it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. See, in case of normal retail sales, you go to the local grocery store and there is no written contract between customer and shopkeeper, but there is an oral or implied contract in that transaction. So contract is there. Contract does not exist if both parties can cancel without penalty. For example, if a customer called you and told you that he will be ordering you like 1,000 units next month. Sorry. So this commitment is not enforceable in law. So that's why this purchase order can be cancelled without penalty. So in this case, this is not a contract. If any party can cancel it without penalty. Okay, I will Rest of the points are quite obvious. Uh, I would like to draw your attention towards this last point, probable collection of consideration. This is very important. If all other contract terms are there, whatever mentioned on the top, all conditions are being met, but it is not probable at the time, at the date of the contract, that you will collect the money. So you cannot, this means this is not a contract. For example, an entity, I suppose I have this material. Yes, you people can see this material, please. You can see this material, lecture examples.
In the meantime, can we take questions?
No, after this, after step number one. Okay. Can you please see this material which is appearing now on the screen? Please answer yes or no.
Yes.
Yes, okay, fine. See, through this example, we will learn two things. First, if an organization enters into a contract, but when you look at the overall scenario, position of the customer, circumstances, conditions, you conclude that at the date of the contract that it is not probable that you will receive the money. Standard says don't recognize revenue. You can keep on reassessing, and subsequently you may conclude that okay, now we can see that it is probable that we will receive the money. At that point in time, you can recognize the revenue. This is the principle which we will learn. What you will do, whatever you have received before that, small amount or a part of that amount, that will be recorded as a liability. Cash or bank debit, liability credit. I will be taking your question, but after certain steps, or even after the completion of first step, I myself will be telling you when you need to write down your question, so that concept could be discussed in continuity. I will revise again. We are discussing step number one. Step number one, you people know that there should be a contract. Only then this step holds. I mean, this step will be there. There should be a contract with the customer. I am discussing and assuming contract is approved by the party. Parties can identify their rights, respective rights. Parties can identify their payment terms, and it has got commercial substance. But it is you determined from the circumstances and from the other information which is available at the date of this contract, that it is not probable that you will receive the money from the customer. Standard says don't recognize it as a revenue. Even if you have received a small amount or part of amount as an advance, but it is probable that you will not collect the money as a whole, so you should not recognize that revenue. Okay, let's see with the help of this example. An entity, a real estate developer, enters into a contract with a customer for the sale of a building for 1 million. The customer intends to open a restaurant in the building. The building is located in an area where new restaurants face high levels of competition, and the customer has little experience in restaurant industry. The customer pays a non-refundable deposit of 50,000 at inception of the contract. Note this, customer has already paid you people 50,000 rupees and enters into a long-term financing agreement with the entity for remaining 95% of the promised consideration. The financing arrangement is provided on a non-recourse basis, which means that if the customer defaults, the entity can repossess the building but cannot seek further compensation from the customer even if the collateral does not cover the full value of the amount owed. The entity's cost of the building is 600,000. The customer obtains control of the building at contract inception. In assessing whether the contract meets the criteria, the entity concludes that the criteria is not met because it is not probable that the entity will collect the consideration to which it is entitled in exchange for the transfer of the building. In reaching this conclusion, the entity observes that the customer's ability and intention to pay may be in doubt because of the following factors. Customer intends to repay loan, which has a significant balance, primarily from income derived from the restaurant. It's restaurant business, which is a business facing significant risk because of high competition in the industry and the customer's limited experience. The customer lacks other income or assets that could be used to repay the loan, and the customer liability under the loan is limited because the loan is non-recourse. On this basis, you concluded that it is not probable. The last condition, the last condition is not being met. This last condition, this one, is not being met. So you will not recognize 1 million as our revenue. Okay, what about 50,000, which you have received in advance? For that, the principle is you will only recognize this 50,000 as revenue if any of these two conditions meet. Number one is the entity has no remaining obligation and substantially all of the consideration has been received and is not refundable. In this case, this condition is not being met. This condition is not relevant because the consideration has substantially all the consideration has not been received. Okay, let's see the other condition. Any of these two conditions. If contract has been terminated and the consideration received is non-refundable. Consideration received is non-refundable, but the contract has not been terminated. This means neither one nor two this transaction is not meeting either of these two. So the consideration, this 50,000, will be treated as a liability. Liability credit, cash debit. And even customer keeps on paying money, you will keep on increasing this liability till the time that it is probable that you will receive the consideration. Okay, now we can take a question from members. Yes, if you people have any question related to step number 1, please feel free to ask. And if we already have any question related to step number 1, Mr. Khayyam, please state those questions.
One of our member is asking to please differentiate between step number 3 and step number 4? How can we specify?
Of course, we shall be discussing inshallah once we have been through step number 3 and 4. So I hope it will be answered, but otherwise you can ask this question again.
Is IFRS related to insurance contract as well? Asked by Saeed Rehan.
No. This is not related to insurance contracts.
Okay, Naveed Ahmad asking with reference to rental contracts for property, what would be the treatment of revenue if we know that tenant has run away? Do we still keep on recognizing the revenue, or we shall stop it at the date when tenant had actually ran away?
See, when he ran away, so at that time, from that time, it is not probable that you will receive anything. So how can you cannot recognize revenue? Next.
But Naveed Ahmad again asking that keeping in mind that tenant has not vacated actually and handed over the property back.
No, Naveed, see, the important thing is all steps and all requirements within each step should be fulfilled before the recognition of revenue. If running away mean like he disappeared without like settling his dues, or he will no longer be your tenant for the coming months. So if you have already recognized the revenue related to the completed months, so that will become the bad debt. And for the future, of course, you cannot recognize the revenue. Maybe I hope it should be clear, or otherwise you can specify your.
Does probable mean more than 50%?
Yes, probable mean more than 50%.
Okay.
Can you like on this AC because it is becoming hot? Keep on asking.
The amount of 50,000 is non-refundable, but why can't we recognize it as a revenue?
Sorry?
The amount of 50,000 is non-refundable, but why can't we recognize it as a revenue, Mohammed Junaid?
Mohammed Junaid, see, this slide is in front of you. Either one or two should meet before recognizing the revenue. One is irrelevant because we have not received substantially all the consideration. And for two, there are two conditions. Consideration received is non-refundable. This is correct. This holds, but contract has not been terminated. So that's why you cannot recognize this 50,000 as a revenue. In two, there are further two conditions. So both conditions should hold before the recognition of the revenue. So this slide is important for you people. I mean, like while deciding should you recognize a part payment as a liability or as revenue. So this slide will help you in making that decision.
Adil Nasir, if example number 1 is in the scope of IFRS 16 or not?
Example number 1
is in the scope of IFRS 16 or not?
Example number 1 is basically a sale on deferred payment. So this is not the right of use. This is outside the scope of IFRS 16. Adil, I hope it should be clear. Next.
Kindly explain the rationale of crediting liability in case of non-refundable deposit. Mariam Alaudi.
Mariam, see, I have summarized these rules in front of you. Simply, Mariam, remember that like any of these two must satisfy before recognizing whatever amount you have received in advance as a revenue. If none of these two conditions hold, then you will be recognizing that amount as a liability.
Okay, can you please explain again point number 1 in step 1, Rabia Shams? Point number 1 in step 1.
Point number 1 in step 1, Rabia, entity has no remaining obligations mean you have fulfilled your obligations. Mean you have transferred the promised goods or services to the client and substantially you have received the money, and there are three conditions within number one, and those that money is non-refundable. If these three conditions are there, so you can recognize the money received as a revenue. Next.
How can we measure the reliability or probability to ensure that there is no overstatement in the revenue?
Who is this?
Fateh.
Fateh, see, as we have seen in like example number one, you will analyze the whole situation, of course, of your customers, like you perform the credit rating, and all these methodologies will be applied before reaching any conclusion. Of course, individual circumstances of your customers play a major role in your decision. Like here we have seen, like they people will pay the amount from the revenue of this restaurant, then they do not have experience of this restaurant. Further, they do not have other assets from which they can like repay your amount. So all these factors are indicating that it is not probable that you will receive the money. So you have to analyze. Mean subjectivity is involved. Mean the approach is not very prescriptive. You have to apply your like mind and analyze the situation. Mean new standards require an accountant to be a little extrovert, to be out of his books and analyze the situation. Next.
If it is non-refundable, then what's the logic behind to recognize it as a liability?
Logic is we have to wait till the contract is terminated, because there are chances like if contract is not terminated, mean we are in fact deferring it. Like in prudent concept, like you do not recognize your revenue until you are very sure about that. You have a reasonable certainty, it is probable. So it is only a prudent concept. You keep it as a liability once the situation is clear. How situation can be cleared? Like project is terminated, and the money which you have received as per the contract, it is non-refundable. Now the situation is clear. Now you can recognize as a revenue. Otherwise, before that, it's a matter of you have taken precautionary measures. In fact, next.
Should the revenue be recognized if customer has utilized the building for 1 year and we receive part payment related to that? It means that we have provided them services.
Who is this?
Shiraz Adilbaksh.
Shiraz, providing services. You mean you have fulfilled your obligation is not the decision factor. The decision factor is it still probable that you will receive them. Okay, we can move further.
There are lots of questions.
Okay, can you please tell it? It's okay.
You can continue with the
Okay.
session.
Okay, we move to the step number 2. So a contract not meeting criteria, and you should like constantly assess this contract to determine whether it subsequently meets the criteria. Okay, this was the step number 1. Now step number 2, identification of the separate performance obligation. Why is identifying the performance obligation is important? Because it determines when and to what extent revenue is recognized. I repeat, why is identifying the performance obligation is important? Because it determines when and to what extent revenue is recognized. In a contract with a customer, there could be one performance obligation. Mean you need to supply, uh, you have one promise, or there is a possibility that there are multiple promises for the supply of goods or services under a contract. In that case, within that contract, there will be more than one performance obligations. You will have to segregate. Okay, this is very critical. Step number one is easy. Don't bother about that. Simply remember slide number 2, where we have learned, like if you have received a part of money, but certain things are not being fulfilled, and keep it just a liability. Once all those conditions are there, simply like treat it as if step number 1 has, step number 1 holds. Step 2 is very important. That is straightforward. Only you need to remember certain things. Step 2 is, in fact, you have to go through your details of your contract. You have to go through the details of your contract and need to ask 2 things to yourself. Number 1, is the good or service capable of being distinct? And is the good or service distinct in the context of the contract? No, this is a standard language. Of course, this is a little difficult. So I shall try to explain 1 and 2. How can you see, like, is the good or service capable of being distinct? Like in a contract, the services and the goods which will be supplied, which are promised in that contract, you need to ask these 2 questions. If the answer to these 2 questions is yes, then those goods and services are distinct, and there are they will be covered under separate performance obligations. What is performance obligation? Performance obligation is, in fact, promise to supply goods or services. In this step, we try to see how many promises are there, 1 or more. How can you see that? Okay, if if the contract cover more than 1 goods or services, if there is a 1 good or service, that is not an issue. Step number 1 is easy, simply 1 performance obligation, 1 promise to supply that good or supply that service. But where you need to ask these 2 questions, when there are apparently more than 1 promises to supply goods and services, or services and services, mean more than 1 promises. Here you need to determine whether all these promises are capable of being being treated as a separate performance obligation, or they will have to be treated as a 1 performance obligation. So this is the question here. Okay, how you can see, like, this is the goods or the service is capable of being distinct. Number 1, if you can note, please note it. Is the good or service capable of being distinct? Okay, let me use one of our okay, I use this. Can you please, it's coming directly for this, please. Thank you very much. See, okay. So number one question. Is the good or service is the good or service capable of being distinct if they are distinct, this means this condition fulfills. How can we see that? Number one, uh, does the entity regularly sell that good or service separately? Normally, I should not say normally, uh, I should say, can we buy that? Oh, where should be hit.
Skip.
Skip. Okay. Can be bought separately? If that service or good can be bought separately. So this means that good or service is a distinct, or if this holds, this means this condition is yes, or can function independently. This is in case of like good, can function independently. If that can function independently from other service or good, so this means this is again distinct. This is again distinct. Or you can see that one is already transferred. One good, okay, this is difficult, debate, but these two will be helpful. I'll be explaining it, the third one, with the help of like examples, otherwise we will stuck on that. Simply, if that good or service can be bought separately, or the supplier regularly or time to time sell that good or service separately, so this means that is distinct. That is a distinct good or service, or mean that is that service or good is not dependent on the other good or service mentioned, promised in the contract. Again, that good or service is distinct. Mean answer to this question is yes. Okay, now come to the second question. The second question is, as I mentioned earlier, answer to both questions should be yes. Only then that item will be distinct. Okay, is the good, number two is the good or service distinct in the context of the contract. In the context of the contract. Okay, so how can we see this? Simply see three things. Simply just try to determine three things. Like, number one, does this require significant significant integration? If yes, this means that service or good is not distinct. Significant integration with other goods and services. Or like, does this require significant customization? Or like modification, one and the same thing? Modification. Again, if yes, this means again this product is not distinct. Or highly interdependent, highly interrelated or interdependent. Okay. We can discuss this with the help of examples. Okay. Let's go to the example number 10. We have here example number 10. This is the example number 10. Okay, example number 10. Here I have handouts for sample number 10. Okay. In this case, an entity, a contractor, enters into a contract to build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various goods and services. Let me open this in front of me as well, so that I should be comfortable so far as its reading is concerned. Okay. Overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of the equipment, and finishing. The promised goods and services are capable of being distinct. That is, the customer can benefit from the goods and the services either on their own or together with other readily available resources. Like if you look at it here, engineering, site clearance, I can use this. Sorry. Okay, let me use this. See, engineering, site clearance, foundation, procurement, construction, piping and wiring, installation of equipment, and finishing. Of course, all these are capable of being distinct. You can hire any other person for foundation. You can hire another person for procurement. Even you can ask this same organization to price it separately. So the first condition is being met. That is, the customer can benefit from the goods or services either on their own or together with other readily available resources. This is basically evidenced by the fact that the entity or the competitors of the entity regularly sells many of these goods and services separately to other customers. In addition, the customer could generate economic benefits from the individual goods and mean they regularly sells these services to the other customers. So this is the key point. So this means this condition, this number one condition is there, can be bought separately. All these services, which are in fact meant for the building of the hospital, can be bought separately. So this means first condition, all these services which are comprising, which are involved in the construction of the hospital are capable of being distinct because of the first reason. You can buy it from this same supplier separately. For piping, you can ask them for piping, you can ask them for engineering, you can ask them for the foundation, you can go for separately. So the first condition is being met. Now let's have a look at about the second condition. See, the second condition is, in fact, the second condition is not being met. Why? Because this is evidenced by the fact that entity provides a significant service of integrating the goods and services. The inputs into the hospital, the combined output for which the customer has contracted. Customer has not contracted for piping, foundation, engineering, construction, finishing. Customer has contracted for a combined output, which is a hospital. So in this case, all these different products and services are in fact integrated with each other. Because they are integrated with each other, so this means they are not capable of being distinct in the context of the contract. So second condition is not being met. So this contract is a single performance obligation. So this contract is a single performance obligation. Because both criteria are not met, the goods and services are not distinct, the entity accounts for all the goods and services in the contract as a single performance obligation, which is the construction of the hospital. Okay, now let's move to the second example. Here, yes, second example. In this case, an entity, a software developer, enters into a contract with a customer to transfer a software license, perform an installation service, and provide unspecified software updates and technical support online and telephone for a 2-year period. The entity sells the license, installation service, and technical support separately. The installation service includes changing the web screen for each type of user. For example, marketing, inventory, management, and information technology. The installation service is routinely performed by other entities and does not significantly modify the software. The software remains functional without the updates and the technical support. See, now my question is, determine which goods and services are distinct in accordance with IFRS 15. The goods and services involved in this scenario, if I just increase its size to make it more visible. So here we can see that we have here software license, installation service, software updates, and technical support. Technical support. Software lessons. Okay. Okay, software lessons. I can mention here. Oh, it is moving. Anyway, software lessons. This is one. So there are four things, four services which we can see from here. Now the question is, which one of them capable of being distinct? So try to answer this, then we shall be discussing. Take 1 minute and try to answer this. Okay. I hope you have made you have made up your mind. See, the software is delivered before other goods and services and remains functional without the updates and the technical support. Thus, the entity concludes that the customer can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available, and the criteria, number one criteria is being met. Number one criteria is met. Mean all these services are distinct. Now let's look at the second criteria in the context of the contract. See, the entity also consider factors for that and determines that the promise to transfer each good and service to the customer is separately identifiable from each of the other promises. Like installation service does not significantly modify or customize the software itself, and as such, the software and installation service are separate outputs promised by the entity instead of inputs used to produce a combined output. Like in case of hospital, all those goods and services were promised by the entity to produce a combined output. Here, it is not the case. These are the separate outputs. Like installation is separate, software is separate. Software can function without that installation. Significant installation integration is not involved. If you just go back to our here you can see that none of these exist. No need of significant integration, no need of significant customization, and service is installation is not dependent on software. Promise of delivery of software is independent. They can deliver software without providing installation service. Company can buy it later on, no problem. So that's why second condition is not met. Second condition meets. Why? Because none of these exist. So that's why all these four are separate. All these four are separate performance obligations. So our performance obligations will be number one will be software license, number two installation service, number three software updates, and number four technical support. Now let's look at case B. In case of case B, the promised goods and services are the same as in case A above, except that the contract specifies that as part of the installation service, the software is to be substantially customized to add significant new functionality to enable the software to interface with other customized software application used by the customer. The customized installation service can be provided by other entities. Determine which goods and services are distinct in accordance with IFRS 15. Please make up your mind, try to identify, try to apply those two conditions. Normally, first condition will not be a problem. Okay. Here, there will be three performance obligations. Customized installation, number one, customized installation, which includes software license. This is number one. Number two, software updates. And number three, technical support. Okay. If we have any question, I can answer them now.
Okay, we have lots of questions over
Yes,
here.
please.
Let me get back to the first one.
Can you please ask?
Should we credit the liability of non-refundable advance in the example as a deferred income?
Which example?
He didn't mention any.
We have example 10, 11, and earlier we have
With regard to non-refundable payment received. Again, not mentioning any.
non-refundable payment received. What is his question? I get it. His point of view. What is his question? Main question.
Should we credit the liability of non-refundable advance in the example as a deferred income? I think from the
No, it is not a
example.
deferred income. It is not simply liability. Simply liability, because for deferred income, you must be knowing why it is a deferred income. Why you feel that it is deferred income?
Maria Malaudin asked,
Deferred income. Yes.
kindly explain the rationale of crediting liability in case of non-refundable deposit. And kindly explain the rationale of crediting liability in case of non-refundable deposit. 50,000. Apologies for the typo error.
Again, what's the question?
Kindly explain the rationale of crediting liability in case of non-refundable deposit.
Okay, Mariam, tell me one question. You have received the money from a customer. Very simple. And that is in fact a part of the revenue. But when you want to recognize it as a revenue and try to apply the criteria given in new standard, you realized that you cannot recognize it as a revenue. So what you will do with that money? Of course, liability. Cash debit, liability credit. Once either contract is terminated, this is already non-refundable, contract is terminated, then you can transfer this amount from liability to revenue. Mayam, I hope it should be clear.
Adil Nasir, in the point number 2, when contract has been terminated, how we recognize revenue?
Simply liability debit, revenue credit.
Okay, if there is no termination clause in the contract or silent, then contract will exist or not? Muhammad Ishaq.
Muhammad Ishaq, if contract is silent, I mean nothing is mentioned, then we will have to look at the specific situation of the transaction. So that specific situation can vary from one contract to other contract. That will help us in deciding the course of action.
Okay. If the customer does not pay further amount and quits, then we will consider 50,000 as income.
Yes.
Kamlesh Kumar.
Yes, complete income. You will debit liability and revenue credit. Next.
Rashid and dear sir, also conduct some webinar on international standards on auditing, please.
Just before the start of this session, Mr. Harun was discussing this point with me. So hopefully we will be inshallah conducting, especially on CAMs, key audit matters, because practically I have seen even within my firm and there is a need. We are already developing a lot of material for usage within our firm, and that is being provided from our head office. But I feel that because there are a large number of firms which do not have such resources, so I think these are important and we shall be considering it. We have already started thinking on these lines. So we should address those areas. But I would request CAM is one area. If all of you people can highlight those areas where you need sessions to be conducted, so that will be very helpful. Because normally audit is considered to be an easy part. Of course, a lot of material is very easy, but still there are areas, especially for those people who are working at a supervisor and managerial director and partner level. There, of course, they are they need to apply certain standards which are really need to be explained, need to be discussed from time to time. So I would request all of you to email to Mr. Harun or to me as well, if you think it is appropriate, those areas where you feel that we should conduct these sessions. Next.
If tenant disappeared and unable to collect remaining considerations, so will there be impact on irrecoverables? Usman.
This is, of course, bad debt. Next.
Okay, if client has given PDC checks against the contract, but we have, I think, post-dated checks.
Post-dated checks.
Against the contract, but we have not received the money at year end. Even post-dated checks are already due or expired. Should we still recognize the revenue? In UAE, if we have checks, we always assume that inflow is always probable, either through client or through court if we have legal course.
You are right. If it is possible, like here in Pakistan, if you, I mean, this will vary from country to country, because even if you have post-dated check these days here in Pakistan, and I mean, there is no guarantee that you will receive this money. So that's why this will vary from country. It is a question of basically law enforcement. If you feel that your law enforcement agencies are working well and you have, I mean, you will be able to recover that money, of course you can recognize your revenue. No problem at all. Next.
I think pay orders are alternative to post-dated checks.
No, they are not in fact alternative. They are basically money in your hand.
Yes.
Actually, here previously, I mean, this was being enforced very strictly, but recently, from a couple of years, government is lenient and law enforcing agencies are a little lenient. But practically, we have found. I am not commenting on any particular government, but practically, we have found that like these post-dated checks are not very helpful here in Pakistan. So you cannot recognize revenue here in Pakistan. Next.
If consideration is non-refundable, then why we are recognizing it as liability? No, we don't have to pay it.
Shiraz, as I explained earlier to Mariam as well. Shiraz, please listen me carefully. You enter into a contract with a customer, and customer paid you like 100 rupee, $100 as advance. Now you want to the question is, because you will be debiting the cash. Now the question is, should I credit revenue? The answer of this question will be like coming from this new standard. And this new standard says, if it is not probable that you will receive the consideration, you should not recognize the revenue. This means revenue cannot be credited. So what should be the credit? Liability will be credited. Shiraz, I hope this is quite logical. I explained it earlier. Even you can listen to it again in recording, please.
If an entity enters into a contract with a potential to supply goods in a bulk quantity, but there is an ambiguity for entity to determine that in how much time the customer will pay for goods dispatched, in fact. Should we recognize this transaction as revenue?
Who is this gentleman?
Burhanuddin.
Burhanuddin, we shall be recognizing it, but the question will arise, how can we determine the transaction price effect? That will be recognized as a revenue. That will be addressed in step number 3. Next.
Can you please explain in slide number 12, if contract criteria is not met in the first place, how can contract be terminated in condition 2 when no contract existed in first place? If sir.
Ifsa, can you repeat his question, what she said?
Okay, can you please explain in slide number 12,
Yes.
if contract criteria is not met in the first place, how can contract be
criteria?
terminated in condition 2
Okay.
when no contract existed in first place?
See, when you enter into a contract will be there in the meaning of the contract. Now the question is, does this contract fulfill the criteria to be identified as a contract under this new standard? This is the issue. Contract will be there. The question is, can we treat it as a contract with the customer under new standard? If all conditions are not there, you cannot treat it as a contract under this new standard. But contract is there. If it is terminated, whatever amount you have received, you will recognize it as revenue. I hope it is clear, because contract means between two parties. There are certain things written down, there are certain clauses there. Now, does this contract qualify to be treated as a contract under this new standard? This is another consideration. I hope it should be clear. This is a very technical small point. I hope it should be clear.
At the inception of the contract, the performance obligation on the side of the supplier is fulfilled as the possession of the building is transferred to the customer.
Yes.
Then why we did not recognize the non-refundable advance payment as a revenue, assuming step 1 is completely met?
If step 1 is completely met, this means step 1 involves, if we just look at this slide, step 1 involves step 1 involves probable collection of consideration. If this condition meets, then you can recognize that. But if you just look at that particular scenario, this condition is not met. Contract is there, but as per 15, that contract is not identified because the last condition is not being met. I hope it should be clear. Next.
If the company sells scratch card to distributors who eventually sell it to the customers, but not sure when the sale will be made, when we should recognize revenue?
See, that amount will be recognized as a deferred revenue. And so far as the credit cards, scratch cards, I suppose these scratch cards related to the mobile services. So whenever they use the mobile services, because the intelligence network of any mobile company provides them the data about the usage of those scratch cards at the end of each reporting period or whenever they require. So based on that usage, you can transfer the amount from deferred revenue to the revenue based on that report. Next.
In the case of export sales, how can both parties approve the contract in written due to the distance? Approximately, these are.
See, in export, it is not like, distance is not an issue these days. You can send your contract, you can do your contract by digital signature. All these services are available. Even in the third world countries. In 2016, I made a contract with IASB. You people, some of you may remember that. I authored a big book on application IFRS application guide. I made a contract with ISB, and both parties signed that contract electronically. So all these things are there. This is not the question. Yes.
Say, for example, we have a consideration of $1 million. When we say substantially, does it mean full $1 million, or it can be 6 lakh?
Substantially mean like 7, 8, this is
More than
judgmental,
50%.
but more than 50%, but it is better more than like 60 or 60. But this is my personal point of view. For sure, more than 50%. For sure. Next.
Could you explain contract terminated in second condition?
Usman, what is your exact question? How should what is the angle that should be explained?
Okay, until the time he writes us with particular theory, we will be having another question. Particularly not in all cases, all the info is available. So how to deal in that case, Mohammed Wasif?
See, ask question. I am expecting that you should ask question about step number 2. That is important.
Mohammed Wasif, again, information about business, customers, other assets. Okay, we will be having another question. Once we have received non-refundable income, we can recognize because we are not going to return. Is the assessment of probability judgmental and depends largely on the management?
Judgmental, of course, judgmental.
Okay, when you read the question, please raise your voice more. All 4 of them are distinct. Yes, the goods and services are distinct. Okay, installation. Please elaborate more on the criteria of customer benefits, either their own or with other readily available goods or services.
Who is this?
Azizur Rahman.
Azizur Rahman, sees. This is being used for this
We
question.
don't have any name with this person because
Okay,
some people can
move to the
also attend offline.
Okay. See, benefit mean like you have a software, you can use it, and it is not like you can have separately installation services. You can benefit from it without obtaining this installation service from that particular supplier, or you can have it and subsequently you can go for the installation service and can benefit from this software. Next.
If there is partial delivery of goods in 2 different tax reporting periods, should we book the revenue in each month or combine it in the last month? It's country with the VAT regime. Goods are apparels that are distinct. Azizur Rahman.
Azizur Rahman, can you repeat your question? I suppose this is
if there is partial delivery of goods in 2 different tax reporting period.
Okay.
Should we book the revenue in each month or combine it in the last month? It is country with VAT regime.
Azizur Rahman, see, this is not the question related to any step. This is basically, in fact, your basic accounting principle. Whatever you supplied in a particular year, that will be recognized in that particular year. and the remaining supply will be recognized as a revenue in the next year when you supplied it. In fact, I mean, this is nothing to do with step number 1 and step number 2. Next.
Can you please explain fund management services? Will it be distinct or not?
See, fund management services. Fund management services. Service. I mean, what is your exact question? In fact, there should be more than one.
Will it be distinct or not?
Fund management, of course, distinct, but it depends on the whole situation. Within that situation, we can see that what other services are being provided, and then applying this criteria. So then we can decide whether all these services will be taken as one or these are distinct. I mean, from this one line, I cannot answer this question.
Can we recognize revenue if we have undated security checks covering the outstanding amount from the customer against the contract?
Again, this depends upon the country. If you are in a country where these checks will be honored anyway, either either by the customer or through the court, then you can, otherwise not.
In case B, I suppose the customized installation that modifies the software is not a distinct service.
You are right.
Kindly tell me whether I am right.
You are right.
Okay, same with
actually you are on those questions which were asked maybe 20 minutes before. Anyway, you are like asking those questions in a row, isn't it?
Yes.
I mean, you are trying not to ignore any of the questions. Okay, fine, no problem. Can you give me this?
In case P goods and services are distinct, it would be appreciated if you conduct webinars on ISAs regarding client acceptance procedures. Thanks.
Client acceptance procedure. Okay, well noted, but it is better because this is in the comment. It is better send an email, small email, one line, to Mr. Haroon and to me as well if you want. So this is noted. This is well, because this is very important area. This is again related to your senior people because they are there to decide should they accept that client or not, and there are multiple requirements like ISAs, law, and many other requirements. Next.
Will examples be shared or not? Zohar?
Definitely, Zohar, definitely along with their answers. They will be shared.
Okay. Okay. What about one-off projects, Zishan Dur?
One-off project, Zishan, that will be a one performance obligation. Simple. Next.
When contract will be seen terminated in condition 2 for advance recognized revenue? When contract will be seen terminated in condition 2?
As per the contract will dictate when the contract will be terminated.
Actually, he is confused, I think, about advance recognizing. When we are already recognizing income, then contract, how can contract be seen as terminated in condition 2?
No, he need to clarify his question. Next.
Okay, what is the definition of distinct goods or services? Tehmina Akhtar.
Tehmina, definition, we are talking about the application, in fact. If the answer to these questions is yes, then those goods and services are distinct. Or if you want to go into further detail, then if the customer can benefit from the goods or service either on its own or together with other resources that are readily available to the customer. So this means that good or service is distinct. And if there is no significant integration, no significant customization, modification, no interdependence on other good, then that good is distinct. Tehmina, I suppose it is clear. Next.
No more questions.
Okay. Okay, we can move further. We have here warranties. Warranties are very important. Like here, normally we need to remember about warranties related to the step number 2, that customer has the option to buy them separately from the product to which it relates. Then that warranty is a separate performance obligation. Like you buy a machine and there is a warranty attached to it. If you can separately buy it if you want, and if you don't want, you can leave it, then this warranty will be treated as a separate performance obligation. Good, that machine is one performance obligation. This warranty is another performance obligation. Second, a warranty which provides a service in addition to the assurance that the product complies with the agreed upon specifications. Again, this warranty will be treated as a separate performance obligation. Other than these two types, any warranty will be treated under International Accounting Standard 37. Okay. Let me explain with the help of an example, because this is important point. This is applicable to most of you, because most of you, maybe a lot of people working in an organization which is providing warranties on their items. So this is very important point. Sorry. See, number one, like you bought a machine plus its warranty for 5 years, say. Or you have the option to buy the machine on, and later on you can go for the warranty. So in this case, where warranties can be bought separately, so here what will be its effect? Here, transaction price, the amount which you have paid for one above, will be divided into machine number one, machine A and B. Warranty mean there are two performance obligations. Mean if you have received like if you have paid like if you have received like 1 million, so you will segregate this 1 million, how much relate to the warranty and how much relate to that machine. Warranty revenue related to warranty will be recognized separately, and for machine separately. If this is not the case, you have received 1 million. In fact, if this is not the case, then like warranty cannot be taken out separately because it is required by law. So why people should go for a separate warranty? Because it is already being covered by the law. So then 1 million, then there will be a one performance obligation, that is machine, and the whole amount of 1 million will be allocated to the machine. So far as the warranty part is concerned, you will be applying International Accounting Standard 37. You will be applying International Accounting Standard 37. Okay. Let's look at the example. Okay. Example is a luggage manufacturer provides all customer with a lifetime warranty that covers all defects and damages, including those arising from normal wear and tear. Okay. In this case, the service type warranty will be a separate performance obligation. The amount which you have paid for that luggage will be divided. The company will divide that transaction price and allocate them between luggage and the service type warranty. So this is related to the warranty. But if like if warranty is not a performance obligation, why? Because company is required by law to provide to cover whatever damages subsequently happen to that good to the customer. This is the legal right of the customer. Then that warranty will be treated under International Accounting Standard 37. Like here in this example, a washing machine sells for $500 with a 1-year warranty. The dealer knows from experience that 15% of these machines develop a fault in the first year and that the average cost of repair is $100. He sells 200 machines. How does he account for this sale? He will recognize revenue of 100,000. Mean all amount will go to the washing machine because here is one performance obligation. The associated provision will be recognized under International Accounting Standard 37. Okay, because a separate warranty is not being provided. So this is all about warranties. Now, step number 3. Step number 3 is determination of the transaction price. Okay, before moving to the step number 3, I just want to highlight one point from step number 2, which is this. If there are series of distinct services that are substantially the same, have the same pattern of transfer the customer, that contract can be treated if you want. I mean, they are distinct. If you want, you can distinct them. You can treat them separately, but you can, if you want, you can treat them as a single performance obligation. So the example is an entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. The contract is signed on 1st January 20X1 and the work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. I again read it. An entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. Each week is distinct. The contract is signed on 1st January 20X1 and work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. In that case, standard allows you to treat those distinct goods and services which are substantially the same, have the same pattern of transfer as a single performance obligation. Okay, now move to the step number 3. Step number 3 is again very important because in step number 3, we learn how can we determine the transaction price. Before discussing the transaction price, we can have a asr prayer break. Okay, ji, welcome back. Determine the transaction price. Uh, Here, this area is important. I mean, the amount of the consideration that an entity expects to be entitled to, and that could be different from your amount given on your invoice, and excludes amounts collected on behalf of a third party, for example, government taxes. That is, I mean, an obvious point, like sale tax is not an income, in fact, or VAT is not an income. You are just collecting, like $100 is your invoice value, and you charge like $5 VAT. So 104 is the cash, but in fact, $5 is not your income. Your income is $100. That is quite obvious. That is, in fact, you are collecting that $5 on behalf of the government. Okay, so in transaction price, we might include variable or contingent consideration, estimated as either the expected value or the most likely amount, to the extent that it is highly probable that a subsequent change in the estimated variable consideration will not result in a significant revenue reversal. I mean, you can only recognize variable or contingent consideration if this condition holds, that there are more than 50% chances that significant reversal will not take place. Small reversal, no problem, but significant reversal would not take place. See, example of variable consideration include discounts, rebates, refunds, price concessions, credits, and penalties. Depending on which method better predicts the amount to which it will be entitled, measure variable consideration by using either the expected value or the most likely amount. When you will, most likely amount will be used when there is only two possible outcomes. So you can use the most likely outcome. For example, an entity either achieve a performance bonus or notes or not. So in this example, there are two possible outcomes. So you can use the most likely outcome, the most likely amount. Expected value is basically the sum of the probability weighted amounts in a range of possible consideration amounts. Maybe an appropriate estimate of the amount of variable consideration for a large number of contracts with similar characteristics. Okay, let's discuss penalties with the help of example. Example we have here, example number 3, I suppose. Example number 3. See, an entity enters into a contract with a customer to build an asset for $1 million. In addition, the terms of the contract include a penalty of $100,000 if the construction is not completed within 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of $900,000 and a variable amount of $100,000 arising from the penalty. So if it is probable, 900,000 you will be receiving, but 100,000 is contingent consideration. You can include this 100,000 in the total consideration if it is probable that significant reversal will not take place. So here you can include. The entity concludes that the consideration includes a fixed amount and a variable amount of arising from the penalty. Okay. Now Next example is this was the example of variable or contingent consideration. Then there could be non-cash consideration. In case of non-cash consideration, you will be including that non-cash consideration in the transaction price. For example, an entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. This is the same example we started earlier, but I stopped where where I do not need the information further to explain the concept at that point in time. But now I'll be reading it in full. An entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. The contract is signed on 1st January 2021 and work begins immediately. In exchange for the service, the customer promises 100 shares of its common stock per week of service, a total of 5,200 shares. For the contract, the terms in the contract require that the shares must be paid upon the successful completion of each week of service. The entity measures its progress towards complete satisfaction of the performance obligation as each week of service is complete. To determine the transaction price, in this case, mean the amount of revenue to be recognized, the entity measures the fair value of the 100 shares that are received upon completion of each weekly service. The entity does not reflect any subsequent changes in the fair value of the shares received or receivable in revenue. So here, entity will be receiving 100 shares. So once a week is over, entity is entitled for those 100 shares. Entity will calculate the fair value of those 100 shares and record the revenue. Any subsequent change to the fair value of those shares will not affect already recognized revenue. So this is the non-cash consideration. Consideration payable to customers. Consideration payable to customers. Example 5 related to this, that will also be this will be deducted. This will be deducted from the revenue amount. Okay, we understand it with the help of example 5. So here is an example 5. An entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. The customer commits to buy at least $15 million of products during the year. The contract also requires the entity to make a non-refundable payment of $1.5 million to the customer at the inception of the contract. The $1.5